Good morning, everybody. Welcome to this webinar presented by TreasuryONE and ETM Analytics. As usually, we've got our very esteemed guests, George Glenos and Quentin Burtonshaw from ETM, and our own local currency strategist, Andre Celia. I'll be hosting it, Vichard Celia from TreasuryONE, as you all know. There's a lot to talk about at the moment. I think everybody wants to know about over the previous weekend, the war in the Middle East broke out again between the Palestinians, Hamas and Israel, and all those heightened geopolitical tensions. What will they have on the market? As everybody expected, probably we wanted emerging markets to be under pressure, but we saw the inverse happening on Monday and Tuesday and Wednesday, with the rand strengthening all the way back from 1940s back to the 1880s. We've subsequently seen after US inflation data yesterday that printed slightly higher, that made yield curve shift in the US a little bit higher again, that emerging markets is on the back foot. So all that it tells me at the moment, short in that space, is that the rand will be vulnerable to what happens in the US. It's ignoring geopolitical tensions at the moment. Oil prices jumped on the back of it, but it's sort of stalled after the initial knee-jerk reaction. But we've got George on the line. He's going to delve into a little bit deeper to see what we're missing. We're just going to have a chat around what's going to happen in the markets, what we see, what we feel. Please weigh in, asking questions on the right-hand side. We'll tackle the questions as we go along. So George, over to you. Let's hear what you're saying, and let's have a chat about it.
Thanks, Vichard. Yeah, it's been a noisy week. I'm just sharing my screen, so when you can see it, please just let me know so that I can then just click
yes,
through
we can see it. Thanks.
Presentation. Okay, perfect. So I've just got a couple of slides. It's not a long presentation like they can sometimes be. It's just to create a little bit of context and to give you some idea of what we're looking at as a result of this war. So this war did come as a little bit of a surprise. It came out of left field. No one was anticipating it other than perhaps the Egyptians, if you to believe the reports out there. But for the most part, this came as a surprise. And so it has lifted geopolitical tensions in that Middle Eastern area. Now, it's quite interesting because at the moment it looks as though it's shaping up to be something of a proxy war, not dissimilar, I guess, to what we're seeing in Ukraine and Russia. Proxy war there again, America fighting Russia through Ukraine. We've got potentially America fighting Iran through Israel, and what goes on between Israel and Hamas. So it's one of these proxy wars. Now, so long as it remains a proxy war, it can remain isolated to what it is. The concern I have, though, is that we're picking up one or two reports that, well, the Syrians are looking at this and saying, oh, well, Egypt might be vulnerable. We've got Hezbollah in the north that operates out of Lebanon saying, oh, well, Israel may be vulnerable. They might both be thinking that this is an opportune time to get stuck into Israel and to deal Israel another almighty blow. They've already been softened up quite a bit by Hamas throwing all those rockets over their borders. So this has the potential to escalate into something a little bit bigger. And as a result of that, we need to obviously take it seriously. It's not there yet. As Vichard indicated, oil prices, initially there was a knee-jerk bounce up, but it wasn't sustained. Well, it's been sustained, but it didn't have any follow-through, not to any significant extent. So let me just take you through a little bit of context, because that also matters. It matters because within the global context of a business cycle, whether you're in a booming environment or whether you're in a contracting environment, can exacerbate the reaction function of the financial markets. So in other words, when things are tight and financial markets are on edge and investors are looking to try and protect themselves as much as possible, you get a geopolitical event like this and people can go scurrying to the sidelines very, very quickly. So where are we in the broader scheme of things? Well, the first thing to say is that we are on our way down. Okay, we're not at the tightest levels we could be. Interest rate hikes in the US have not fully played out yet. They're still conducting quantitative tightening. That red line still has further to drop, but as of August, we've unwound a lot of the stimulus that was applied during COVID, and all of that excess saving that is still in the system is set to unwind over the next 3 to 5 months. As that does so, that red line comes down further and we get ourselves closer to more distressed territory. The significance of this chart is evident in the labels that you see at the top and the bottom of the peaks and troughs. Quite clearly at the bottom is where you start to see all the crises unfold. And it's not to say that this picks the crises, it's just to say that when the tide goes out, because if you look at this as a tidal chart, when the tide goes out, you tend to find that financial markets are more vulnerable when this red line is towards the bottom than when this red line is towards the top. And so the fact that we are heading down towards the bottom tells us that we are approaching a more vulnerable state that we need to be sensitive to and aware of. It's not surprising, therefore, that US rates appear to be topping out. So whether we look at the Fed or the Bank of England, you can see there's not much more left for interest rates to do. In fact, if anything, the markets are becoming increasingly convinced that these two central banks are going to leave rates exactly where they are right now, and that if anything, going forward, that the probability is shifting towards rate cuts. That even holds for the ECB. So around the world, your big central banks are now thinking that they've done enough. Again, it's an indication that because they've done enough, that they are seeing some sensitivities creeping into their domestic economies. That's the reason why they don't want to hike rates any further, which means that financial markets obviously become a little more vulnerable.
George, sorry, can I
roll
just
forward to?
Sorry, George,
Yeah.
quick jump in there. If you go back to the previous slide about the yield curves, one of the reasons why we probably think that the Fed is not going to hike, correct me if I'm wrong, is that a lot of the longer dated yield curves, your 10 years and 30 years, has steepened quite significantly. So the longer dated yield curves has done the job for the Fed, meaning that the Fed doesn't necessarily have to control the short end because the long end has done the work for the Fed. Am I correct in stating that?
Well, so what's happened is that through the course of the past couple of years, you've had a big inversion that's happened on that yield curve. So you've had your longer dated, so the entire curve shifted higher. That entire curve shifting higher is what has constrained liquidity across the economy. But what we've seen over the past year or so is that that curve has inverted quite a bit. And that curve inversion is typically a sign of an impending recession. So again, when one looks at the yield curve, it's typically when the yields at the short end, which is what this chart on the left-hand side shows, are peaking and are expected to come back down again. That's when you start to see recessionary conditions become more prevalent. The only reason why central banks will tend to cut rates more aggressively is when they have room to do so. That happens during inflation moderation, and it happens during recessionary conditions when times become really, really tough. So you are correct in saying that the yield curve has done a lot of the heavy lifting for the Fed because the entire curve has shifted higher and constrained interest payments across the private sector throughout the economy in the US. But it's not just in the US. It's actually happened. It's happened in other major economies as well. Where there's a big difference is in the domestic market. In the domestic market, you're quite right. The curve has steepened, where the longer end of the curve is doing quite a lot of damage to longer term refinancing or financing of big investment projects. And that's not altogether good news, but it does mean that it's another constraint to this economy. And I mean, if there's a silver lining to that scenario, it's that a tighter economic environment tends to reduce inflation, which again allows the Reserve Bank to cut interest rates, and we're off to the races again. But that's a cyclical issue, and that's going to unfold through the course of time. But right now, we've got the potential risk of some volatility arising because of what's happening in the Middle East, which is, what the next chart is supposed to show. Now, to give you an idea, this chart tends to isolate periods of geopolitical risk pretty well. So in the early 90s, we had the Soviet Union collapse. Then we had the 9/11 attacks that you've got here in 01 odd. You've got the invasion of Iraq that you see, the invasion of Ukraine. We haven't as yet seen a spike up, only because this is monthly data. So it's of September, as of September. In October, we'll get to see just how big the impact of this geopolitical risk is going to be. At this point in time, I expect a slight tick up, but I don't think it's going to be of the order of magnitude that we saw through the invasion of Ukraine, which ultimately we should be thankful for, because you roll forward to things like what's happened in the oil prices, and you will notice that in this particular chart, every time we've had oil prices spiking quite dramatically, it's tended to coincide with recessionary type conditions. The only reason why that didn't happen through this latest period is because of the extraordinary amount of monetary stimulation that was thrown at the global economy by the major central banks. But typically, when you find that oil prices spike as they did during the war in Ukraine, you tend to find that it has a fairly substantial impact on the global economy, on the global cyclical slowdown, and obviously for South Africa, it has a very direct impact in that it affects negatively South Africa's terms of trade. So we rely quite heavily on the coal price, for example, to generate a lot of our exports. Now, we're being constrained by the very poor performance of Transnet and the ports and all of that, but for the most part, the coal price has helped offset a lot of that, and the coal mines have found other ways of getting coal out of the country. So it hasn't shown up entirely in the data as yet. But an oil price spike without a corresponding spike in the coal price will mean that this line over here, South Africa's terms of trade, will head lower. And as that heads lower, it impacts South Africa's trade and current accounts. And the trade account, as you can see on the left-hand side, yes, we're in surplus still, but the surplus is nothing like it was during the pandemic. And so the level of support that South Africa has currently from its trade account for the rand, in other words, the support for the rand that comes from the trade account, is not what it used to be. So we are more vulnerable and we are more sensitive. Our current account, as you see on the chart on the right, is negative. It's in deficit. So, we do need to pay attention to what's going on in the Middle East, because it has the potential to disrupt some trade flows for South Africa, especially as it pertains to the terms of trade and how those terms of trade ultimately impact the trade account. And if this, in other words, becomes something bigger, we may have some issues to worry about, especially if it starts to find expression in an oil price that spikes a lot more than it has moved so far. So that's just the context that we have at the moment. I didn't want to dwell too much on a whole horde of charts, but I'm very happy to just have an open discussion now about what the implications of that are for different trading positions and how companies can potentially navigate that.
George, could I ask a question? Given this war or this latest set of conflict that's in the world has happened so far down or so far into the mature business cycle, do you think the impact on the oil price would have probably been more acute had we been in a phase where liquidity was more plentiful, we weren't in a rate hike cycle, we weren't seeing the demand for oil taper off into the US, and potentially, I'm not saying the war is ever advantageous, but the timing of this so late in the business cycle is why its impact on the financial markets has been as limited as it has?
Yeah, I think there probably is some truth to that. I think at the moment, probably another big reason is the fact that, well, neither Hamas and Gaza nor Israel are big oil producers. So at the moment, there's nothing directly impacting the production of oil or the transportation of oil. So if we had to see, for example, Iran entering this war, and that Iran is a big producer of oil, then I think you're going to see oil prices spike, regardless of the liquidity conditions. If the Straits of Hormuz, for example, start to get barricaded as part of a military operation, or in any
or something like that.
Exactly. So when we get to the point where there's physical disruption of oil supplies, and I think you see oil move pretty rapidly. But even there, I mean, have a look at what happened in Russia with Ukraine. Russia's oil was supposedly disrupted, and oil was that we weren't going to be buying from Russia, and all of this kind of stuff. Well, it's found a way to seep into the market through other means, and whether that's been through some rogue countries which are not beholden to the US, however that may look. The fact of the matter is that the market rebalanced itself, and oil prices were in fact starting to come back down pre this war in Israel. So at this point in time, I think the thing that I'm focused on most is whether or not this war escalates to become a broader geopolitical issue than it is right now. For now, it remains contained. And whilst it remains contained, the impact on South Africa and the rest of the world will be fairly limited. But these things can change overnight. So, that's why I have the TV on most days and sitting watching what's going on, not because I relish in all of this dramatic news, but because I'm hoping like crazy that it doesn't become more than what it is.
Yeah. So George, just to add on to that, is interesting. You spoke about the oil. If you look at Malaysia's, if you go and dissect Malaysia's current account and trade balance, all of a sudden their oil exports spiked. They're exporting far more oil than they ever produced. So it's just been Russia shipping the oil to Malaysia, rebranding it, and Malaysia exporting it. But it just as a side note. Andre, if you've got anything to add, what are you? We know we're not political analysts or anything by any means, but what is your views on the current situation?
Well, if I look at the war, and then I would agree with George 100%, we have to see and carefully watch how this plays out and whether it escalates and drags in other people into this war. As long as it stays contained between Israel and the Gaza Strip, with outside comments that would then not really influence oil prices or anything that much. But the minute that other people start getting dragged in and more people start joining this, then we're in for a rocky ride. But it is my honest feeling that that will not happen. 75 years is what I read that this has been going on. If I have it correct, this has been going on for way more than 75 years. It's been going on forever, and it's going to go on forever, because this, at the end of the day, is all about religion, and they're not seemingly be able to stop mingling into each other's personal affairs. But that's been a thing for the world. But I hopefully this will not escalate outside of the Israeli Gaza Strip area. Nobody else will get dragged in, and I think oil prices will remain contained and the impact on currency markets will remain contained. I still think that the main drivers around is still what happens in the US with interest rates, what happens in the world with interest rates, and the movement of funds because of that into high yield carrying assets in safe haven countries versus high yields in emerging markets.
Yeah, so to add on to that, Veron also a question. He says, given the war, do we foresee a short-term flight to the safe haven of the dollar and therefore further ZAR depreciation?
Yeah, I mean, it was quite interesting because we actually didn't see that happen this week. So there was no flight to the dollar. The only reason why the dollars popped up yesterday was because of some higher than expected US inflation numbers. Save for that, there was no major flight to safety. Again, at this stage of the game, I think it's just a function of the fact that this war right now is contained. Therefore, there is no reason to fly to the dollar. If it were to become something a lot more substantial, well, then I think all bets are off. Then you do potentially see the dollar regaining its safe haven status and attracting a lot of flow in that direction. But lest we forget, and I think this is important context, the dollar is extremely expensive at the moment. And I'm not just referring to the dollar being expensive versus the rand. I'm talking about the dollar being expensive to just about every major currency. So there is a lot to be said about this dollar pricing in a tremendous amount of rotation to the US. And I mean, we've heard it all through the course of the past 6 months. US exceptionalism has been a term that's come up again and again and again. And that exceptionalism relates very specifically to the fact that the US can tolerate much higher interest rates than anybody else seems to be able to do. And the fact that they have been able to generate growth more than most other countries have been able to do. What people conveniently forget is that so much of that growth and so much of this resilience that we're seeing is very much a function of all the kind of stimulus that was applied and the magnitude of the stimulus that was applied that hasn't yet fully seeped out of the system. We're still living through the tail end of that. Okay, so US exceptionalism for me is a concept that will be replaced by US fragility later through 2024. It's not going to remain this way, primarily because while they've removed $1 trillion this year of excess liquidity, they've still got a long way to go. But as they continue to remove liquidity through the course of 24, through quantitative tightening and the effects of the high interest rates play out, and excess savings is completely out of the system, and you start to find things like house prices are falling, which they are at the moment, and you find that the quality of the labor force improvements are dipping. So in other words, there's more people getting employed in part-time work than full-time work. All of these are signs that there's one or two cracks starting to come up in the US economy. And I think, we need to be careful about just assuming that the US is always going to be able to attract those flows as a safe haven. It's doing so now because the data that it's producing now is good. I have some serious reservations as to whether it's going to be able to sustain that going forward for all the reasons that I've given. So, it's going to be, I think if we revisit this conversation 6 months from now and we've got a new set of data updated, I think we'll have a clearer picture as to whether this US exceptionalism is actually a theme that can roll out through the course of the next couple of years, or whether it was literally just a function of the excess savings that just hadn't wound out of the system yet, and that now that they have, the US is kind of like behaving like the rest of the world, and actually wasn't all that special to begin with.
Yeah, and if you sorry, Andre, you want to go first? I want to add something. Yeah, go for it.
If you look at what happens in the world, and this sort of links up with Richard's answer there, what will happen, or what will the impact be on emerging markets if the dollar becomes less expensive? George is speaking about a lot of cracks that's beginning to show on the dollar side. It is expensive, but there's cracks. Now, fortunately enough, I'm very old, and I've been around for a long time. In 1985, we were looking at the then Deutsche Mark trading at levels of 347 against the US dollar. And everybody was looking towards the 350 mark being broken and the Deutsche Mark going for a ball of whatever, and the dollar just continuing on its strengthening path. And it turned around and moved lower substantially in a very short period of time. These things has got a way of creeping up on you and catching you unaware, because you get so drawn up or drawn into these strong dollar, and everything, flights to safe haven and wars, whatever. But suddenly one day you wake up and you see this turnaround and the cracks becoming an eruption of a volcano. So we have to listen carefully to what George say and listen and look at these cracks happening, and actually every now and then zoom in on these cracks and see whether it's a bigger crack or whether the crack is being filled with polyfiller. And I think a lot of the cracks are being filled with polyfiller, but eventually it will crack again. Apart from that, if I look at the rand, and we all speak about a weak rand because we're above 19, but if I look over the last 4 or 5 weeks, and I look at a euro that's been trading around 21 against the rand, and I look at a pound that's above 24 against the rand, then at this point in time, we're trading at 20 and we're trading at 23 or close to 23 on the pound. Says to me that the rand has actually got a bit of resilience here in spite of a strong dollar on a basket of currencies showing a little bit of strength. And so we also need to take cognizance of that there is not just weakness in the rand, there's weakness solely against the dollar, but against a basket of currencies, it's done reasonably well over the last month.
So if you look at my favorite currency to follow is the Aussie Rand, is back at 12 Rand. That should actually just be closer to 11.50 than the Rand's at fair value. So we've actually done well because Aussie dollar came from 12.40 all the way back now to 12. But just as a side note, if you look at non-farm payroll numbers that came out, it jumped on Friday last week. Nice headline number, 330,000 jobs. But if you dissect that non-farm payrolls number again, it's a lot of temporary jobs that's created. So temporary jobs was through the roof, but permanent jobs is actually down, it's decreasing. So it's a factor of two things. It's all people can't get permanent jobs because if you look at the Amazons and the Teslas and the Microsofts and the Metas and the Alphabets, what's now Google, they've all been laying off staff. But all the temporary jobs has been coming along at the moment. And it's all been because of the summer in the US, but that's sort of going to dwindle down now again. So the thing is summer jobs dwindling down, plus a lot of people are taking on second jobs to sustain themselves because stuff in the US is expensive. Because if you look at 30-year mortgage rates, it's at above 8%. It's the highest it's been in 23 years. So mortgage rates is up. Car financing of cars still up. Student debts need to be repaid again. So there's a lot of stuff that's seeping at the moment. So the non-farm payrolls data looks good. Unemployment data jumped actually from 3.6 to 3.8%. So the data still looks good, but that cracks is starting to emerge. And it's people taking on second jobs to sustain themselves, to keep a living, because with inflation running still at elevated levels, it's still putting the economy under pressure. So Warren has asked here is, following on our comment regarding the dollar becoming less expensive, what will happen to emerging market currencies should the US enter into a recession? So, George, I want to hand over to you now, but the short answer is, obviously, in my opinion, however George says, in the short term, if it happens, the initial knee-jerk will be emerging markets under pressure. But actually, the rand on its own tends to perform better when the world economy is struggling, if you go back in history. I want to hear what your comments is, George.
Yeah, you took the words out of my mouth. That's basically what happens. Ironically, the rand tends to perform better through tough economic times. And part of the reason is the retrenchment of demand for imports. But the other is that utilization of many of South Africa's exports actually remains more resilient. So they hold their own a lot more than South Africa's demand for imports. And so you tend to find that the trade account switches back in South Africa's favor, and it tends to end up supporting the rand. And you can see, more recent examples of that. You can go back to 2009, 2010, when you had, a big global recession, and through 2010, the rand actually did pretty well. It recovered quite strongly, and everybody thought, oh, well, through this global recession, everybody's going to flood to the dollar. Well, they didn't, because the US was reducing interest rates very aggressively and started to go down the road of quantitative easing, again, very aggressively. So South Africa and emerging markets more generally tend to perform better through interestingly through the latter part of a slowdown, you tend to find that emerging markets have jacked up interest rates a lot more than developed markets have in the run up to a downturn or a recession. That has been the case this time as well. So yes, the DMs have caught up to some degree, but EM rates are a lot higher. So in a world where you're running away from equities and you're looking for bonds and emerging market bonds, unless you're a country that's facing a fiscal crisis and a debt default, many of these countries also land up attracting quite a lot of capital from abroad, people just seeking to try and extract as much yield as possible. Ironically, you tend to sometimes find emerging markets do better in an environment like that. So, you got to get through that initial ugly patch, as Vicard was alluding to, where you get this initial knee jerk, which is a negative one for emerging markets. People flood to the dollar, but what follows after that is a period of more constructive performance of emerging markets, especially Rand.
Yeah, so it will be a rocky one. So it will be a rocky ride. I don't think the range is going to go one direction. Probably 20s is still on the cards. Don't fall it out, because we still got our. I'm going to touch on it, George, and Andre, you can add on. We've got our own medium-term budget speech coming up on 1 November, which can be a little bit of a ball and chain for the rand. So, because I don't think our fiscus is doing too well at the moment if you look at our terms of trade and so on. So I think in the short term, all the US they've got the recession, we've got our own problems. I think we're in for a rocky ride. And I don't think the rand's going to go to 16 or 1650s anytime soon in the next 3-4 months from that space. Our feeling is rather we're going to trade between like 1825, 1925, breaking the top side and the bottom side for short periods of time, but sort of stabilizing in that higher range, which is a little bit weaker than where fair value is for the rand, but that's just what our feeling is. I'm not sure if Andre or George want to add anything to that.
Yeah, Andre, do you want to go first?
I think when we come to the 1st of November, when Mr. Godangwana tells us what happens, a lot of that negativity has gone through the market, and I think everybody expects the absolute worst. So I don't think that that's going to push us to 20. And I think he will paint over some of the horrible cracks for us quite neatly with his magic little brush. But I don't think, if I look going forward and I look at the problems that we have and I look at how we solve problems in this country at the moment, I don't think that I'm in a space where I can see a rand going to fair value of around 16.5 or 17 very soon. I think that's a long way off. I think there is the possibility of strength coming in for short term, and we could see 1850, we could see 1840. I honestly don't think much better than that. On the upside, negativity, wars, etc., the vulnerability is still there. I don't think we really break out of the 1940, 1950 range. So I agree with you, Vichar. I think we stay within an 18.5, 19.5 range for quite some time, with on very short periods breaking out either way, but coming back within that range very quickly.
Yeah, I mean, just to add to that, now, the beginning of this year, I was a lot more bullish on Rand in the latter part of this year than what's played out. And it's been quite frustrating for me to watch, because it's not on the basis of market fundamentals so much as it's been on the back of just a really weak performance by our government, and whether that be the way that they've run their SOEs or not run their SOEs, or whether that be a function of the rapidly deteriorating fiscal position, which you alluded to, Vicard. There's been a lot of risk priced into SA Inc. And you can see that reflected in the bond market. And that there is a very strong correlation between the performance of the bond market and the kind of portfolio flows that foreigners send to SA shores. So when the bond market tends to do well, it attracts flow from abroad, and the rand tends to find quite a lot of support. Well, that just hasn't happened this year. Despite the fact that our interest rates at the long end are north of 13%, or have been, they've come back a little bit now, but they have been north of 13%, you would expect quite a different outcome, and yet that hasn't played out because people are very nervous about what's going to happen on the 1st of November. Now, we've looked into that at ETM, and what we have discovered is that there are avenues that Godongwana can tap into to stabilize the budget. He may allude to, for example, lifting of the VAT rate. He may reduce expenditure of military. He's going to cut down on some expenditures elsewhere in the system. So he can make up the shortfall to some degree. Anything north of a budget deficit of around 5.5%, I think, sends the rand a little bit weaker. Anything 5% and below as a budget deficit, and I think the rand recovers out of a relief rally. But even if it does do that, I think we need to just have healthy perspective on the state that South Africa finds itself in right now. Most of South Africa's municipalities are bankrupt. Most of them owe Eskom a tremendous amount of money. They cannot repay it. There is it's kind of like a bit of an amnesty that the government is offering these municipalities on their debt to Eskom, and they are trying to help them restructure and find ways of paying it back. But those are unfunded liabilities which are nowhere near resolved and could find themselves onto the public balance sheet, going forward. I do know that the government is going to try and resist the temptation to go too austere ahead of next year's elections. So there's not going to be any tremendous reforms that are announced in the medium-term budget, which is, potentially a lost opportunity to try and help the rand recover and generate a more virtuous cycle in South African financial markets. But it's a risk factor. So, let's roll forward to the 1st of November and see what gets announced. As I said, it's got the potential to stage a bit of a recovery if Godongwana, pulls a rabbit out of the hat and finds a little bit of spare capacity here and there to plug a hole in the short term. But short of implementing some proper fiscal reforms come February next year, I'm afraid that my ideas of a dollar rand going back to 16 and 16.5 fair value is going to have to wait until they eventually wake up to the reality that either they reform or South Africa goes through a very ugly patch. And I think that's where we find ourselves at the moment. So it really is over to the finance minister on the 1st of November. And, I'm hoping that I think he gets it, to be honest. I don't think he's a bad finance minister, to be fair to him. I think he's got certain political realities that he can't necessarily just get away from, and one of them is the upcoming elections.
I think if you look at the political realities, then there is people in government trying to say the right things and do the right things. I saw yesterday that the presidency said that they want to move Transnet and rail into private hands. And then comes the little added one, under the Department of Public Enterprises. So for Pete's sake, guys, read carefully. If it's under the Department of Public Enterprises, Mango, SAA, Eskom, whatever, is all under the Department of Public Enterprises, and their boards continuously get fired, etc., etc., etc. By whom? Mr. Pravin Gordhan. So instead of moving Transnet into private hands and rail into private hands, can we move Mr. Pravin Gordhan into private hands and get rid of him? Maybe things will go better. But that's what I've said. The way things are being done in our government does not give me hope of any movement forward. It's just treading the mill, stepping on the treadmill, not going anywhere.
Running around in circles. Yeah, but it's because of the election coming up. I'm going to close it off here. Quentin, you've been quiet. Have you got any final comments before we close it off?
Yeah, I suppose one of the comments that George and the team were discussing that I think we just need to be very cognizant of is that price pressures globally are up. I think social pressures are growing dramatically across the world. And if there are pockets of let's call it unrest or angst, price pressures, inflationary pressures, and all of that is the flame that lights the tinderbox, right? We saw it in Arab Spring, we saw it in a couple of places, and I think that we just need to be cognizant of that. That certain social dynamics inflame things, and I mean, George, I don't know if you want to add to that, but it is something that we're keeping an eye on globally.
Yeah, thanks, Quinn. I mean, you've alluded to something that I omitted when I was chatting about oil prices and the impact of oil prices, and what that could do. Part of the frustration for poor people is that they're being left progressively further and further behind. And as you've seen domestically, we've had riots domestically with people unable to feed themselves, so they resort to looting and all sorts of other things. Well, we're not alone. It's happened elsewhere around the world, and Quinn's quite right to point out that that's another side effect of what's going on in the Middle East, and again, I think why we need to just keep a very close watch on what goes on there, and hope like crazy that it doesn't become a wider spread issue.
Yeah, thanks, Andre. Thanks, George. Thanks, Quentin.
Thanks.
Wrap it up there. As anything, there's a lot of volatility probably around the corner, ups and downs, like always. Please reach out to us if you've got any questions, anything we need to attend to. We're always here. You've got our numbers. We'll try and answer and assist and manage risk as good as possible. But yeah, thanks for attending. Enjoy your Friday and go the Bokke on Sunday. So cheers.
Absolutely. Go Bokke.
All the best, guys. Have a great weekend.
All right, guys.
Cheers.
Thank you. Bye-bye.
Yeah.